I think our 22nd, sorry, I'll get the number, but to our post-budget forum. We analyze the budget for 2021-2022, financial year 2021-2022. So the Institute of Economic Affairs will be, with a team of 3 people, will be taking us through the highlights of our analysis of the national budget. And first, just as a way of introduction, the Institute of Economic Affairs is a public policy organization. We are a think tank, and what we do is basically promote debate and dialogue on public policy issues. And the IEA, through its public finance management program, has been over the years analyzing the budget. With one of our flagship projects is basically we have what we call the pre and post budget work. So the IEA is actually known for its budget work. And so every year, of course, we look at the budget during its preparation, and we do some work towards influencing the budget preparation or budget formulation. And as soon as the budget is tabled in Parliament, we review the same, and of course hold a forum to basically educate the public on what the budget means to them, but at the same time share our inputs with the Budget and Appropriation Committee of the National Assembly. So today, like we've done in the past, we will be sharing some of the highlights of our analysis, and we have 3 presenters. They will start with Noah Wamalo, who will be looking at the macro and the budget outturn. Then thereafter, we will have Dami Jatani, who will take us through the sector analysis, and then Raphael Moya will cap it all with the revenue taxation, or with the taxation proposals. So those are the 3 key areas in which we'll take you through. Now, just to mention as a way of introduction is, of course, the preparation of the budget in terms of its content. We all, of course, are aware that COVID, the first wave, we are currently in the 3rd wave, has had a major impact on the economy. And throughout at least the first wave of COVID, certain gains that the country had made were actually reversed. For instance, we had made some progress in poverty reduction, but one of the major effects of COVID is that, and this is actually statistics from KNBS, the number of the poor increased actually by 2 million people. So that's one of the most critical effects of COVID that we need to be aware of. And obviously it has impacted on the economy in general. We've had effects in terms of revenue, reduction in revenue collection, and some of this will be mentioned in the analysis. Of course, we are currently in the 3rd wave, and this actually paints a picture of the context in which the budget was prepared. The other point to note is the fact that Kenya entered into a program with the IMF, what is called the Extended Credit Facility and the Extended Fund Facility Arrangement for approximately 2.4 million USD. So the idea of this facility was just basically to strengthen our external position. Again, this obviously connotes the context in which the budget was prepared. So I just wanted to highlight those things just to be aware of as we go into the presentation. So now, without further ado, I would like to welcome our first presenter, Noah Wamalwa.
Yeah, thanks,
Noah?
John.
Yes, who is uploading
maybe upload the slide.
Yeah, so as Noah uploads the slide, just to mention again, I think we are now familiar with the drift of webinars. So thereafter, once we are done with the presentations by the three speakers, we'll of course open it up for plenary discussion or question and answer. And so please feel free to note whatever question or comment that you may have in our chat box. And during the plenary session, I'll go through those questions, as well as, of course, invite you to ask whatever question that you may have. And the presentation will take about 40 minutes. So Noah, please go ahead.
Yes, good morning, everyone. My name is Noah Wamalwa. I work at Institute of Economic Affairs under the Public Finance Management Program. Yeah, thanks for tuning in. And I will start off with the outline of our presentation. So we'll touch on the macroeconomic outlook and then go to the budget outturn, after which we'll look at the revenue performance, then consolidated fund services and the debt position. And then my colleague, Dharmi Jatani, will provide the sectoral analysis. Then my colleague, Raphael Muya, will talk about taxation proposals, and we'll end with the key messages. So the macroeconomic outlook provides the context in which the budget was formulated. And so we all know the impact of COVID, the COVID pandemic, on generally the economic performance and how that affected the revenue. So when we look at the trend line, even before COVID, as you can see in our chart, the purple line, we see a slight decrease in the economic performance. This is the real GDP growth rates on quarterly basis. But then we see a shock in the fourth quarter of 2019-20. That is from April, 1st April to 30th June last year. So on overall, the economy reduced. The performance, the real output of the GDP reduced by 5.5% on overall. But then we see the main contributor of that reduction was the service sector, the tertiary, which reduced by 11%. And it is explained mainly by the containment measures that were enforced by the government in a bid to contain the spread of the pandemic. So we can say what drove or what boosted the economic performance during that period is the performance in the primary sector, which is mainly agriculture. So it grew by 7.4%. Yeah, so the main message here is that there was a shock due to COVID, but then notwithstanding that fact, the economy was underperforming, as you can see by the reduction of the economic growth rate. So what we see in quarter 1, 2020-21, that is the period 1st July to 30th September last year, there was improvement mainly because of the relaxation of the containment measures, which boosted especially service sector, which improved to -4.7. But still, it shows that we are not out of the woods yet. The effect of the pandemic will still be felt, especially this year and probably in the coming year. So this is the general macroeconomic outlook. And when you look at the inflation, inflationary pressures, increases in the year-to-year prices of commodities, we see that on overall, the inflation was controlled it was not high. It was 6.2 in the first quarter of 2020. First quarter, that is January to 31st March last year. Then it reduced to 4.5, then to 4%. So you can say it was within the target, the inflation target by the central bank. So the target is within 5%, 2.5% below or above 5%. So when it is 4%, as we see in quarter 3, 2020, it is within the target. But then one key point to note is the fuel. So fuel, we see it increased from 0.9 to 1.5. That increase is explained by some of the measures that were enforced. That is increase in the taxation of fuel commodities. Yeah, but then we can say on overall, the inflation is not out of the target. Then let me talk about the budget outturn. So this is the analysis of the 2021-22 budget, and we compare with the previous year's budget. So I would like us to focus on the total expenditure, GOK. This combines everything, including the county governments, all the 3 arms of government, and contingency and equalization fund. So on overall, the total budget is 3.6 trillion. Yeah, including CFS. So that's on total, everything. But then when you compare with the revenue that is estimated to be raised, which is 2.1, as you can see in the first row, revenue including grants, 2.1 trillion, we see that there's a huge budget deficit, which is 1.5 trillion. As you can see at the bottom there, under deficit financing. Now, when you compare these numbers with the previous, we see that the total deficit has increased by 23.96. That is huge. And given that it's above 1.5 trillion, it is taking a large share of the total expenditure. Yeah, so when we track the main components of the budget, 3.6 trillion budget in 2021-22, we find that the CFS component, that is Consolidated Fund Services, which mainly comprises the public debt, 88% of that, has increased highly from 21% in 2016-17 to 36%, as you can see, the purple bar. Now, this huge increase in the CFS has had a negative impact on not only county government, because we see it has reduced from 11% to 10%. Judiciary as well, judiciary is now 0.5% of the entire budget. But also national executive, it's reduced from 66% to 22%. And as you will see later in the sectoral analysis, we see that while the total budget has increased to 3.6 trillion, while the total budget has increased to 3.6 trillion, the share that goes to the MDS or sectors, those are ministries, departments, and agencies, has reduced slightly. So the reason behind that is explained by huge increase in the CFS. So it's a question of the accumulation, why we are accumulating a lot of budget deficit, and which is then leading to increase in the servicing of this debt, thus affecting the allocation to the respective ministries, departments, and agencies. Yes, so I would also like to talk about the trends in the revenue. So what we are doing here is to compare the target revenue against the actual revenue. So we want to establish does the proposed revenue that the government estimates to raise, to what extent does it meet that revenue? So the dotted lines, point, and the black line there shows the average for the target, while the green bars and the cutting green line shows the actual revenue that was realized. So there are two things that we see. So on overall, we see a rise both in the target and the actual revenues. But then we see that the target has been above the actual. But then that difference, that gap, has been widening. So not only has the government been missing on the targeted revenue, but that miss or that gap has been widening, which shows that we are not really planning well or forecasting well our revenues. So it could be that we do not have capacity to forecast accurately, or it could be a political economy issue here, such that we want to present an optimistic optimistic budgets. That is, you're presenting high revenues, and yet in fact, what you'll realize at the end of the day is lower than what you have presented. So the impact of this is understated budget deficit. So previously we had seen that the total budget deficit is 1.5, yeah. But then 1.5 budget deficit, when you take 3.6 total budget minus 2.1 total revenue. So because that revenue, we highly think from the trends that it is overstated or optimistic. And then that is then leading to understatement of the budget deficit. Now, we also see that there are some structural problems in our economy, because when you take the share of total tax revenue to GDP, the ratio has been falling. It falls from an average of 17% in 2016-17, as you can see by the cross line, to 15.4 in 2019-20. So because that slight difference in percentage point is a significant amount when you take the absolute value, so that decrease is really affecting the budget implementation, because when you do not meet the revenue as planned, you either borrow domestically or even externally, or you either cut your budgets. So that has a huge implication on the budget implementation. And because of COVID, as you can see in Q1, the ratio has dropped to 12.9. Yeah. So at this point, I would like to talk about the consolidated fund services. And the main components of consolidated fund services include mainly guaranteed debt, subscriptions to international organizations, miscellaneous services, salaries and allowances, pensions, interest paid on the debt, that is debt servicing, and then redemption of the debt. Redemption is the principal. So when you look at the main components, when you combine interest and redemption, which makes debt servicing charges, it is 88 in 2021-22, and has been large. It was 90. It was 90 in 2015-16. So because of that large percentage, it means that it means it is the debt or debt servicing that is driving the total CFS component. So the total CFS component has risen from 466, as you can see, the second line above, 466 billion to 1.3 trillion in 2021-22. That's a huge increase. And this then confirms what we've been saying, that it is the debt servicing that has really disrupted the total budget has increased a lot. Now, because when you look at all the debt servicing, now it is 88. It means out of 100 shillings that will be repaying as mandatory repayments, the debt component there is 88. So out of 100, you are paying 88 shillings. Now, the effect of this, maybe I need also to explain further what we had. The impact of increase in the consolidated fund services. So we see that the consolidated fund services is 3.3, as you can see in this chart. And the main effect of this is because it reduces the main effect is that it reduces the flexibility of the budget. Now, because the first part we have discretionary, which is 2.3. Discretionary means that the government has a leeway to shift the budget, or let's say to suspend certain certain budget. But then when we have non-discretionary, increase in non-discretionary, it takes that portion, it takes that leeway. It reduces that flexibility, because the government has to repay the debt, for example. So there's no way the government can suspend a payment of the debt. So that effect of increase in CFS, we can say it has reduced or highly reducing the flexibility of the budget. Yeah. So from this point, I would also like to talk about the effect of the debt servicing on the domestic, or let's say private sector. So the total redemption, when you take when you take the two, interest plus redemption, which is 88%, the interest, or when you have the calculate the ratio between interest and redemption, it is 48%. The interest is 48, while the redemption is 52, which means that the loans that we are borrowing, a large part of it is generating interest. Interest is generated very high on the loans that we have borrowed. Then that interest from the domestic loans that we've borrowed makes 75% of the total, which means the domestic loans are more expensive. And given that government is borrowing highly from the domestic, which is about 52%, it means that it is crowding out the private sector. So the private the banks see it more profitable to lend to government, and by so doing, it is taking part of the capital that it will have lent to the private sector. Yes, so at this point, let me talk about the debt sustainability analysis. So the effect of high borrowing has had a huge impact on the debt sustainability. So we see that currently, as we speak, the total debt in nominal terms is 70.4. But then when we calculate that in present value, it is 61.3, while the threshold is 74%. But then when you look at the revenue, total public debt to revenue and grants, it is currently it is 338.1, which is above the threshold, 300 threshold, while debt service to revenue and grants, it is 53 0.8, while the threshold is 30. Now we have breached, when you look at the debt sustainability, we have breached on two solvency, they call them solvency ratios. The last two, present value of public debt to revenue and grants, and debt service to revenue and grants. So this is mainly because our revenues have been underperforming. Yes, so this means that the revenues, there'll be much more pressure on the revenues going forward, given especially because of the pandemic and generally because of the structural problem that we have, the government borrowing heavily from the private sector. Now, the overall assessment, according to IMF Bank and World Bank, they say the overall risk of the external debt distress is high. Then the granularity, that is the probability that the effect of debt will lead to the disruption in the economy, they say it is sustainable. Yeah, so in a nutshell, we are having high debt distress and it's likely to impact negatively on the overall budget. Yeah, so that ends my section. I would like to invite my colleague Dharmi Jatani to take us through the sector analysis.
Thank you, Noah, for the first part of the presentation. As introduced earlier, my name is Dharmi Jatani, and I work at, under the Public Finance Management Program at the Institute of Economic Affairs. I'll be taking us through the sector analysis with focus on the financial year 2021-2022. Noah, kindly go to my first slide. Yes, so as Noah gave in the budget outturn, there is an increase in the total budget for financial year 2021-2022. It increased from 3.1 to 3.6 trillion, but we see that the same is not reflected to in the allocation towards ministries, departments, and agencies. So in financial year 2020-2021, the MDAs were allocated 1.91 trillion, but there's a slight reduction to 1.9 trillion in this coming financial year. And also as a share, as an average of per capita, we see that the allocations to the MDAs have also reduced from Kenyan shillings 38,000 to 37,000. So in overall, despite the positive increase in the total budget, the allocation towards all the ministries, the total allocation has reduced. Again, to note on this slide is there is the Public Finance Management Act requirement that requires that at least 30% of the total budget towards ministries, departments, and agencies should not be less than 30%. So we see the blue bars shows the recurrent allocation, which is mostly compensation to employees or operation and maintenance. And then there is the development allocation. And we see that in the past 2 years, the total allocation has adhered to the requirement as provided in the Public Finance Management Act. So 36% in 2020, 2021, and in this coming financial year. Despite a slight decrease, it's still within the provisions of at least 30%. And now, next slide. Yeah, so this slide shows us all the sectors. So the ministries, departments, and agencies are composed of these 10 sectors. And this slide shows that in the last 2 years, For example, when we look at the education sector, we see that last financial year they were allocated 508 billion, but this year there's a slight increase to 509 billion on the slide on the right, on the graph on the right. Most sectors have seen a reduction in allocation in this coming financial year, except for health sector, which will see an allocation, which will receive an allocation of 121 billion this financial year, and this is an increase from 119. The other sector is also social protection, right? The allocation increases to 72 billion from 55 billion in the previous financial year. This can be attributed to the increase in allocation across the cash transfer services, to be specific, the Hunger Safety Net program, and also the people living with disability. So those cash transfers have both received 100% increment in this financial year, mostly attributed to the challenges that the vulnerable groups have faced, and also the challenges of people losing their source of income. And so the Hunger Safety Net program also saw an increase in allocation to be able to support more people this coming financial year. So also we see the public administration and international relations, the allocation increased to 304 billion from 269. The public administration and international relations sector, mostly under it is the National Treasury, the Ministry of Affairs, and so the increase in allocation to the public relations sector can be attributed to the transfer of two programs to National Treasury, to be specific, the rail transport program and the marine transport program. So these two programs have been transferred to the National Treasury. So the increase there can be attributed to that. And also we see an increase in health sector. So definitely as we try to mitigate the effects of the pandemic and the health sector tries to meet the demand required, that is also important that there is, despite it being little, but it's one of the sectors that did not face cuts but received an increase. Next slide, Noah. So this shows classifications for each of the sectors. Now trying to show that out of the 1.9 trillion allocated to across the sectors, what proportion does each sector we receive? So we see that the largest one is the education sector at 27% out of the 1.9, and then followed by energy at 18%. We see that this is a decrease in allocation compared to the previous financial year. And the next is the public administration and international relations. We see there's an increase there from 14% to 16%. So as stated earlier, this could be attributed to the addition of programs under National Treasury, which is under the public administration and international relations sector. But we see that the next one is governance, justice, law and order, which also, despite receiving a slight, it has received a slight increase of 10%. So this year we see that the governance, justice, law and order will takes up 10% of the total budget allocated to all the sectors. Agriculture, rural and urban development receives only 4% of these total provisions at 60 Kenyan shillings, 69 billion. And we see that, as Noah showed us in the previous slides on the macroeconomic performance, agriculture sector remains strong strong despite the effects of the pandemic and the slowdown in economic growth, but the allocation does not reflect support towards ensuring the sustainability of that good performance. But we know agriculture at the national level is mostly policy making, so maybe we should look deeper to see if this is reflected also in allocations to county governments. And also, when we look at environment protection, water and natural resources, the allocation increased slightly to 6% this financial year. This is also important considering that COVID-19 prevention requires a lot of improvement in hygiene and sanitation. So that's also a good indicator. But overall, we notice that the per capita, the average per capita reduces from 38 to 37. So despite, other than the three sectors, across all other sectors, we see a reduction in allocation. So these sectors had stated their requirements in the medium-term expenditure framework, but we noticed that across most sectors, what is required deviates from what is allocated to those sectors. So it is evident that this year's budget will still be under a lot of pressure, and there will be a lot of prioritization that needs to be done so as to ensure that despite the deviation from what is required, what is allocated can still be efficiently used to achieve some of the priorities, some of the programs in the budget. Next slide, Noah. Yeah, so this slide shows us the economic classification. The previous slide showed how the total budget of 1.9 trillion will be shared across all sectors. So this shows how the 1.9 trillion in terms of economic classification, we see that across all the sectors, the current transfers to government agencies takes the largest share of the budget at 29%, followed by the compensation to employees, which has also slightly increased from 25% to 26%. Analysis of also the public wage bill shows that the public wage bill has been increasing. It is also important to watch that so that the public wage bill does not become unsustainable and does not take away the development side of the expenditure. And then there's the capital transfers to government agencies that also takes up 24%, a slight increase also of 2% from financial year 2020-21. Yes, so we see that financial assets, social benefits, and other expenses take up quite a small share of the proportion, and that largely most of the allocation is taken up by compensation and current transfers to government agencies. That brings me to the end of my presentation. Thank you.
Thank you, Darmi. Yeah, thank you, Darmi. I'd like us to look at the key messages for this part of the presentation. These are mainly the key findings that we see according to the trends. So the first is that we have huge budget deficits, and this has been accumulating over the years. And we conclude that they are the main drivers of the public debt. So not only has the debt increased to 70.4% of GDP, but also the debt servicing charges, when you look at the interest and the redemption, has increased significantly, and it has disproportionately affected the county allocation and also judiciary. Yes, so the high cost of debt, as we see, has reduced the overall MDA allocation. So while the total the total budget this year, which is 3.6 trillion, has increased, what has gone to the MDS is only 1.9. It has reduced from 1.91 to 1.90. So the effect of that is because of high consolidated debt service. Then we think that this has led, this has affected, has increased the opportunity cost, because on one hand we have huge budget deficits, on the other we have huge debt servicing. So we are borrowing to repay, and so what we are repaying, when you look at it in terms of the opportunity cost, had we invested, maybe the returns could have been higher. So we think that budgeting is not efficient, given that we have huge budget deficits, which is pushing us to borrow more. Then we also think that in terms of revenue forecasting, because when you look at the target revenues against the actual revenues, we have a huge gap, which has been increasing over time. We think that the revenues that is being set is unrealistic. And so there is high need to develop more appropriate models to forecast accurately, but also address the political economy issue such that we should not be presenting an optimistic, optimistic budgets when in reality we do not meet those targets. Yeah, so we also think there is structural issues in our economy leading to underperformance of the revenue generally. And we think that this is because of the heavy domestic borrowing, which has crowded out the private sector. Yeah, thanks. I would like to invite my colleague, Rafael Muya, to take us through the taxation proposals.
Okay, good morning, everyone. My name is Rafael Muya, and I work at the Institute of Economic Affairs under the Public Finance Management Program. I'll be sharing with you the taxation proposals for the financial year 2021-2022. Let's go to the next slide, Noah. Noah, next slide. Thank you. I want to mention one thing, is that the Cabinet Secretary for the National Treasury actually tabled both the estimates of expenditure and the finance bill on 29th of April this year. And what is contained in the finance bill is that quite a raft of proposals in terms of how we are supposed to finance the expenditure side. And the finance bill focuses on 4 key areas. That is the income tax, the value added tax, the procedure act, and the miscellaneous and the exercise duty act. Those are some of the key areas that the finance bill is actually trying to focus to see how best we can be able to raise the revenue of this country. But number 2 to mention is that if you look at in terms of the tax policy measures that are put in place, and you look at the estimates of expenditure, and you look at the finance bill, is that the projected revenue for this financial year stands at 2.03 billion, and this is inclusive of the appropriation in aid. These are the transactions within the departments and ministries, and this represents around 16.3% of GDP. And out of this, the ordinary revenue, that is if you raise the grants, is that it represents around 1.55 billion shillings, which represent again around 14.3% of GDP. And revenue mobilization actually is very critical in trying to achieve the fiscal deficit. And as Noah mentioned, is that if you look at the fiscal deficit, it's stands at around 1.5 billion shillings. That is fiscal deficit. And if you look at the level, the ordinary revenue that is supposed to be generated, it's around 1.7 billion. So in terms of actually, even the revenue that a country is supposed is raising is actually not. If you look at the fiscal deficit and the revenue that is almost the same. So it raises a lot of questions in terms of how critical it is for this country to ensure that we are raising enough resources to finance our own budget. Let's go to the next slide. No, next slide, please. Now, what are some of the measures that the Kenya Revenue Authority and the National Treasury are trying to put in place to ensure that revenue mobilization is in place? And one of the things that I need to mention is that revenue performance in this country and all over the world is underpinned by tax reforms. And one of the things the Minister of Finance mentioned when he was sharing the estimate is that to enhance the revenue measures in this country, the focus will be trying to ensure that the measures that were contained in the Finance Act 2020 will be enhanced by ensuring that issues to do with minimum tax and digital service tax, those are some of the areas that will be improved to ensure that we have enough resources to ensure that we are able to finance the budget. And number two is that the Kenya Revenue Authority actually will continue to strengthen and upgrading the IC system so that, and of course, as I mentioned, in terms of digital tax and the minimum tax, those are some of the areas because they want to enhance administration of those taxes. Number three is, of course, sharing of information, and and I will be mentioning this, one of the key areas that the finance act mentioned, the finance bill mentioned is that they will be rewarding actually informants. Somebody, if you are able as a person, if you provide information leading to identification and recovery of unassessed taxes and duties, actually there will be a reward. And I know it is in place, which starts at around 100,000, but it will be enhanced to around 500,000. And then number four is, of course, trying to the administration to will consider revenue enhancement initiative, which include trying to include increase in taxes. Now let's go to the next slide, please. Now, I'll start by and I'll just give a highlight in terms of some of the taxation measures. One of them is the income tax proposals, and one of the measures that the bill tries to mention is that the amendment of income tax by inserting the word control. And one of the reasons in our thinking is that the amendment is aimed at filling the gap in the tax laws and streamlining the tax amendment that we are introduced in the year 2020. Number two is the derision of the derision of permanent establishment, and it will be substituted by issues of fixed place of business through which business is fully or partially carried on. And the new definition of this establishment is just a broader meaning than the current income tax, and it clearly indicates that an establishment is deemed to be created in Kenya. The other proposal in the income tax is that the bill actually seeks to amend the current definition of a digital marketplace with the following new definition, that is income accruing from business carried out over the internet or electronic shall be subjected to a tax. And the reasoning behind this is that widening the scope of the reasoning or our comment from our end is that the bill is trying to widen the scope of who is liable to the payment of digital service tax, and also the amendment reflects the government increased effort of trying to target players in the digital market, in the digital market market for increased tax revenue generation. Next slide now. Again, the bill proposes to amend and include businesses that are carried over the internet or electronic, and this is an online platform which enables users to sell or provide services or goods or other property to other users. And the reasoning again, and the digital service tax is computed actually at 1.5% of the gross transaction value of the digital service. And our thinking again here is that the proposal reflects the government increased effort in targeting players in digital market for increased tax revenue. And as I mentioned, is that one of the fiscal policies that are being put in place is to try and target players who are in the digital market. Again, another proposal that in the income tax is a tax rebate for graduate in technical and vocational education and training. And again, the reasoning behind this is that is to encourage the employers to employ persons from these institutions, and eligible employers will be around to deduct. They will be subjected to tax deduction for at least 10 trainees from this institution. On income tax, finally, there is a proposal to change the computation of capital allowances from actually reducing balance to equal installments. And the reasoning behind this is that assets which can be depreciated completed to zero, and taxpayers can easily track capital allowances within a short period of time. Now let's go to the next slide, please. Now let's focus. Another focus is on proposed amendment to the value-added tax, and key on the VAT Act, VAT section is on medical goods. They will be subjected from standard to exempt, and what we are saying is that one of the things that the bill mentioned is that one of the key issues that the bill mentioned is that it will be subjected to approval by the cabinet secretary responsible for the matters related to health. And our thinking is that this is a risk. A risk is that the finance bill is supposed once this one goes through, it means that the cabinet secretary for the Ministry of Health can be able to exempt items, medical items. And what we know is that this is supposed to be approved by Parliament, so that the issue can be effective. Another proposal in the finance bill is the exemption on export services. Number 3, there is also a change in VAT status of good from standard rate, and the items that are included there include milk in powder, food supplement. And what our thinking is that the exemptions on these items could raise the cost of these items. And then on regulation under the VAT Act, we are saying to take effect after the publication of Section 67(2) of the VAT, provide that regulation should be tabled in Parliament. Again, it goes together with the first proposal I mentioned on VAT, where the cabinet secretary. What we are saying is that the bill the regulations should go together to the Parliament, so that it is passed by the members of Parliament. And therefore, what we are proposing is that this bill, the proposed provision actually should be deleted. Now let's go to the next slide. On the exercise duty, we have highlighted three key items. One is on locally manufactured and imported confectionery and chocolate manufactured, which will be subjected to excise duty. And what we are saying is that these items are bound to increase in terms of prices, and it may make the items to be uncompetitive compared to the imported items. And then there will be reintroduction of excise duty on betting, and this will be subjected to a 20% of the amount at stake. And what we can see here is that there was some issues, I think, last year in terms of discussing about introduction of the same under the excise duty. And what we are anticipating is that the betting sector will proactively perhaps engage with the government to reconsider the proposed duty. And then the other excise duty that is being proposed by finance bill is on fees and commission and in respect of loans. And then what we see here is that if the loans will be subjected to excise duty, then what it means is that there will be reduced profit by financial institutions, and of course the other effect is that it will make the loans and other facilities more expensive for the consumers. Now let's go to the next slide. The other proposal is on change from the from specific rate regime to ad valorem rate regime for motorcycles of tariffs 87.11 to 15%. And our thinking is that of course the government will be trying to get some cash from that particular sector. The other proposal is on imported glass bottles, not subject to excise duty. And what we are saying is that perhaps this could be a welcome move, especially for glass bottle manufacturers in the region who look to export their product to Kenya, because of course they will not be subjected to excise duty. And then there will be an introduction of excise duty on jewelry and nicotine product. And this perhaps it will be aimed at enhancing revenue collection from jewelry made precious metals. Now let's go to the next slide. The on Tax Procedure Act, the bill proposes to include selling goods and services over a digital marketplace as a transaction from which a tax bill is required. And therefore what we are saying here is that vendors trading over digital marketplace will be required actually to comply with the tax obligation. The other proposal on Tax Procedure Act is actually to empower the commissioner to seek intervention of relevant authority in the collection of taxes. Therefore, what we see here is that the commissioner will be perhaps given a security in terms of trying to ensure that he is able to collect the revenue required by the government. And then the other aspect is the bill proposes to increase the period within which assessment may be made by the commissioner under section 31(4) and under section 31 subsection 6 from actually 5 years to 7 years. Now let's go to the next slide, please. On miscellaneous fees and levies, the finance bill actually proposes the application for refunds, ascertainment and repayment of fees and levies of a period levies over paid or paid fees in errors. And this is a good move because actually taxpayers who normally pay levies and fees in errors, sometimes they go through hard time. If this one is actually passed, then it means it is a relief to the taxpayers. And then the bill also proposes the exemption of goods valued at 5 billion shillings or more imported in the interest of public or promoting investment from import declaration fee and area development fee. And this is I have to say that these are some of the proposals that IEA shared with the National Treasury, perhaps one of the key things that they have picked from our alternative budget. No, let's go to the next slide, please. Okay, so in terms of the non-tax legislative amendments, other taxes, I call them, I will just mention two. And I mentioned this about rewarding of informants, that persons who provide information leading to identification or recovery of an asset, unassessed taxes or duties, actually will be rewarded by an amount. I know the current amount stands at around 100,000, but the bill proposes that the amount would go up to around 500,000 Kenya shillings. And of course, what we see out of this is actually the effort by the government to ensure that we are able to finance finance our budget with as much resources as possible. And then in terms of other tax measures, the bill also proposes to introduce the definition of a corporate trustee to refer to a limited corporate limited liability company incorporated under the Companies Act 2015. So I'll reach there, and thank you very much. And I handle this now back to John.
Yeah, thanks a lot, Raphael, Darmi, and Noah, for taking us through some of the highlights of our analysis of the national budget. I know we are eager to go into the next session, but just as a way of summary, basically the story that the three speakers have shared is that our budget outlay is about 3.6 for 2021-2022, 3.6 trillion, up from just about 3.1 trillion. That's about 15% growth. Now, from this outlay, it comprises of various allocation to the three arms of government, of course, the national, the executive, judiciary, and parliament, as well as county governments. And one of the interesting findings from this is that, which is actually a recurring thing that we've noted, is that the portion that goes towards servicing of our debt, largely servicing of our debt, pensions and the like, which is called the Consolidated Fund Services, went up from 32% to 36%. And actually this has been squeezing out allocation to the other components. So that's one of the clearest picture that we see from that. Then our fiscal deficit increased by 24% from about 1.2 to 1.5 trillion. Now, and you can already see this is actually what is leading to the CFS, mandatory payment, that has been growing up. And Noah actually shared some additional interesting facts in terms of breaking this down to show the different components. The fact that, for instance, interest payment has been going up, largely driven by domestic borrowing. Then further breakdown was shared by highlights of further breakdown of the expenditure outlay was shared by Darmi, basically the sector analysis. And from that, I think the clear message there is that there's a priority shift actually from energy and infrastructure, energy, ICT and infrastructure related in terms of allocation, from which went down from 22 to 18%. So the shift is actually towards public administration and international relations, which went up from 14 to 16%. But the allocation to the other sectors, more or less, it was a mirror reflection for this year vis-a-vis 2020-2021. And of course, Darmi also noted some of the drivers for that increased or the shift in terms of focus for this ensuing financial year. And this is largely related to some of the projects and programs within the National Treasury that falls under the Public Administration and Relations and International Relations Sector Working Group. Then looking at expenditure from what we call economic classification, just a transposition of expenditure in terms of money that is going to wages, money that is going towards operation and maintenance, capital expenditure and the like, we see that the two largest components are actually allocation towards transfers to government agencies, parastatals basically, which comprise about 29% of the total allocations to ministries, departments, and agencies. And then the portion going to wages was about 25, actually went up from 25 to 26%, but there was a drop in operation and maintenance. So again, the implication there is that whereas, of course, government is investing quite a bit on capital infrastructure development, the expectation is that there should be corresponding allocations towards ensuring that there's proper operations, maintenance, and the like. But we've seen there's a drop in O&M. And then finally, Raphael actually took us through the taxation proposal. So we see the projected estimates is about of revenue is about 2.1 trillion from 1.9. And so basically what the story that Raphael was taking us through is how the government expects to mobilize this revenue. And so he did this through the taxation proposals, which comprised of certain administrative measures, tax procedure measures, and various examples. For instance, with regard to income tax, the idea is basically to widen tax base and get more into the digital market. And there were some questions actually coming from last year about definition of where the incidence of tax falls, especially in the digital marketplace. And so this taxation, the finance bill basically tried to define this, make it clear in terms of where the incidence of tax falls. And then on VAT, it was just basically a few examples of some proposed exemption, VAT exemptions from the standard rate of 16% for food supplements, milk and powder, and of course Raphael mentioned the implications of this, and there are also other taxation proposals with regard to excise duty and other taxes. So in a nutshell, that's basically the summary of the story that our three speakers have taken us through. So without further ado, I would like now to welcome our participants to ask questions, to engage us on questions or post whatever comments they may have. And so feel free we will have 2 rounds of question and answer. So in these first rounds, I would like to allow any 3 or 4 questions. So feel free, I see one in the chat box, but I would like to invite anyone to raise whatever question that they may have. Feel free to unmute yourself and pose your question to any of the 3 panelists. Our 3 speakers. As you are warming up to this, I see one from Team Jaggi. This is directed to Darmi. Or is it Darmi who has tried to respond? Okay, so I think Darmi has tried to respond to something. Oh, sorry. So the question from Team Jaggi was, is the national government still budgets for implementation of programs for the agricultural sector? So I think what Njagi is asking for is a breakdown of allocation to the agricultural sector, and of course, the Army has responded that we'll obviously share this in our analysis, in our brief. So of course, these are just basically highlights, but we'll share in the analysis. We'll provide the details of the breakdown by each of the sectors that we covered. But Darmi, if you want to weigh in on this, feel free to. But before you do that, I see Emma. Emma, you can unmute yourself. Your hand is raised. Emma Gishui.
Oh, okay. I think you can hear me. I just wanted to have a deeper explanation and possibly the impact of the change in definition, of a corporate trustee to refer to a limited liability, because I tend to think that possibly maybe could impact on SMEs and all that. I don't know, but I just need to understand it as an SME company holder, company owner. Sorry.
Okay, thanks Emma for that. So Raphael, I think you've noted that. Martin Mulwa.
Hello, can you hear me loud and clear?
Yes, we can. Please go
Thank
ahead.
you very much, IEA team. I think this is a very wonderful presentation that you just put forward. I think I have just a particular question in regards to what Noah and Darmi presented. I think quite clearly the debt issue is a big problem within the Kenyan context, but I wonder to what extent does it crowd out social spending, and by social spending I'm particularly making reference to the social protection sector, education and health, given that these are very essential sectors in terms of during now the stabilization period and the recovery period. So I wonder to what extent did the analysis, or if the answer is not there, it would be interesting to just get a sense of how debt servicing in itself crowds out social spending. And I think the next one also goes to Raphael. You mentioned that there's increased VAT on regressive on some of the food items. So I wonder to what extent government, even within itself, considered the effect on this on vulnerable groups. And the last one, maybe perhaps this is not relevant to the presenters, but to just have a discussion around is to what extent is our budget really responsive to gender issues? Thank you very much, and over.
Thanks, Martin. Raphael and Noah, I think you've noted that, the question on debt, and then Raphael on VAT exemption. Any other? Do we have any? Before I go to the chat box. There's one here from Mukunya. So the question is there a clause? So this again is to Noah. Is there a clause or legal requirement on allocation to the three arms of government? The executive has a much higher budget than the judiciary, than the other two arms of government. So Noah, you can respond, you can take note of that. Then I think an additional one, a follow-up from Team Jage. So what Njage is saying is that is worried about the competitiveness of our productive sectors with the increase in excise duty, as highlighted by Raphael. This may be counterproductive, especially if it results in contraction in tax revenue. Can IEA consider some impact studies further in the year? So Raphael, take note of that. Then again from Emma, in the Miscellaneous Fees and Levies Act, I wonder why the time span within which refunds shall be made is not mentioned. So I guess we can respond. We will respond to this as a first round of question and answer, and then we'll open it up again for another round. So let's start with Raphael, reverse order, Raphael, Darmi, and then Noah. Raphael?
John, yeah. Let me start with the first question on the definition of corporate trust and the effect that it would have in the impact that you'd have on SMEs. I think one of the things that I need to mention is that one of the impact I would mention is that this would, and this is my view, this would lead to perhaps better asset protection for perhaps the family, and of course with an effect in terms of having a higher investment in return. The other question from Mulwa is on increased. What is the effect? The effect that would have on VAT on food items, and if there is an increase in food items, I think one of the things that will happen is that it will increase the cost of the food items, which will definitely affect the household. And our thinking is that some of the proposals that are being put ahead in terms of increasing the VAT on some of these products, I think in our view is that some of these proposals should actually be dropped, particularly during this time of the pandemic. The question by Team Jagi of Tigemeo is that yes, I think going forward, I think this is an idea that IEA will take in place to consider conducting perhaps a study on in terms of impact that some of these things that would have in the economy. So thank you, John.
Thanks, Raphael. Darmi?
Thank you, John. I'll start by responding to the question on if there is any provision, like a legal requirement on allocation to the three arms of governments. It is true that the executive has a much higher budget than especially the judiciary, and there's no specific statement on what percentage should go to each arm, but under Article 201 of the Constitution, on principles of public finance, it requires that the revenue raised nationally shall be shared equitably among national and county governments. So if it says that it should be shared equitably, so clearly from the allocation, it does not show an equitable, it does not give an equitable picture, because we see one arm receives less than 1% and the executive gets a much higher share. So I think that is where the provision for equitable share of the national revenue is stated. Moving on to the impact of the debts on provision of social services, we haven't done an analysis to state exactly what the percentage is. But when you look at the analysis, as shown by Noah, when we have 3.6, but 1.2 of that, 1.2 trillion of the 3.6 is not available to be spent, but rather to pay back debt. What is left means that despite all these sectors stating their requirements for this financial year, their requirements cannot be met. So for example, if I can take the agriculture sector, So as it also responds to Tim's question, you find that for this financial year, they had requested 121 billion, but they will only receive 69 billion. So I think the impact of the large debt servicing can be reflected in how the sectors cannot receive what they require, and they have to prioritize with what is given. So yeah, it is important that we also do an analysis, an impact analysis, so that it comes out clearly, but it is evident also from the allocations and the deviation from the requirements by the sectors. Thank you, John.
Yeah, thanks, Rwanda.
Yeah.
Thanks, Darmi. Noah?
Yes, thanks, Darmi. I will just add on the question by Mkuya on whether there is a clause defining what should go to each of the arm of the government. So as Darmi said, yes, there is no explicit clause that requires a certain percentage allocation. But then the main reason, I mean, leaving it open has an advantage in that the budget allocation is mainly a political process. So the National Assembly mainly is in charge of allocating the resources across. So while the Commission on Revenue Allocation recommends what should be allocated, for example, to county governments, it does not decide. So it's left with the National Assembly to battle it to see what share should go to, for example, county governments. But then the assumption in the Constitution is that there will be goodwill across the board. So there is assumption of interdependence of each arms of government to ensure equitable distribution of the resources. Yeah, that is it. Thanks, John.
Yeah, thanks, Noah, Darmi, and Raphael. Let me see whether, just to add, I mean, just basically to add on the issue of allocation to the executive vis-a-vis the other two arms of government. In addition to what both Darmi and Noah have mentioned, that we have the principles as provided in Chapter 12 of the Constitution, principles of equity, interdependence, and the like. The other way would be basically like the true reflection of what would be expected to go to each of those is just basically based on the functions at each of the three arms, their functions and the mandates. And whereas at the county government level, CRA tried to do some work, but the aspect of costing of the functions at each of these levels, the three levels at the national, the three arms of government at the national level, as well as the counties, we don't have any study that has costed, I mean, that has that provides evidence of the cost of providing services based on their functions. But no doubt, given the size of the executive, there would be expectation that substantial resources would go towards enabling it discharge its services. I think the other thing to note is just a general comment on VAT exemption is that, yes, with the new VAT law, I think in 20, that was introduced when in 20, enacted in 2013, the idea was to reduce the number of goods, the number of items, goods and services that were exempt. But what we've been seeing, what we are experiencing, or what we've seen since 2013 is that there's been a lot of exemptions and zero rating, which is basically distorting a VAT, whereas that original objective was to reduce the high number of goods and services that were actually exempt, given the challenges that this brings about in terms of its management, administration, as well as dealing with the issues of VAT refunds and the like. So there seems to be a reversal of the earlier intended objective of having a small number of goods and items, especially basic commodities that are exempt and zero rated, to make them more affordable to the general public. So there's just basically a need to look at just issues of VAT and implication that it has in terms of reversing some of those original expected original objectives as was set in 2013. So those are just the two things I wanted to add. So we will now open it up for the final round of question and answer. Again, feel free to either raise your hand or unmute yourself. From the chat box, I can see, let me see. There are there are a few other questions that have been raised. So from Emma, no, that I already asked. From Martin Molwa, access to vaccines is now becoming an economic policy issue, and recovery is highly dependent on vaccines. How much has it been allocated? Allocation to enable access to vaccine, and is it sufficient? Darmi or Noah, you can take note of that. Then from Shelmith Mugo, our question is, will there be a significant reduction of CFS when contributory pension by civil servants is effected? Noah or Raphael, you can take note of that. Then again from Emma, it is curious that the finance bill seeks to remove VAT exemptions on export of services in the proposed amendments to the VAT. Raphael, you can weigh in on that. Then from Mohammed Alid, has there been any confirmation regarding particular changes on the income tax? Again, Raphael, you can take note of that. So that's it in terms of questions that I see in the chat box. Yeah, I see Okello's hand raised. Okello, please, you can unmute yourself.
Yes, my concern is touching on the recurrent budget against the development budget. Do we have a way in which we could at least either make sure that the recurrent budget does not in some way outcrowd the development budget? And number two, when the government is trying to increase the base for taxation, is it also at the same time trying to reduce the rate of taxation, so that now, in as much as trying to bring everybody on board on taxation, we do not overtax people, and especially when it comes to the informal sector, and especially for the beginners?
Thanks, Okello. So the first question is about the expenditure mix recurrent development. So Darmi or Noah, you can take note of that. Then the second one, again, it's about tax base versus tax rate. Raphael, I think you've noted that. Let me see. An opportunity for the final question from our participants. I think there is one that Emma had asked about the change in definition of corporate trustees to refer to a limited liability company under the Companies Act 2015. So what she wanted to understand is the impact this has on MSMEs, on MSME sector. Raphael, you please take note of that. Then the final one from Martin. Martin, you can unmute yourself.
Yeah, thanks very much, and sorry for coming back. I think I just have a burning one and a curious one. I wonder to what extent, in terms of resource mobilization, can Kenya accommodate progressive taxes like wealth tax? Is there room for that as opposed to focusing on regressive taxes as part of expanding domestic resource mobilization? Hope my question was clear.
Yeah, it is. Thanks, Martin. Okay, so what I will do is allow our speakers, starting with Noah. Noah, then we'll go to Darmi and then Raphael. I guess you've all picked or not taken note of whatever question that you'd like to respond to. So Noah, let's start with you.
Yeah, thanks, John. And thanks, Martin Mulwa, for your question regarding access to vaccines. Yeah, so to begin with, we see the total allocation to health, the health sector, increased from 119 billion in the previous year to 121 billion in this particular year, 2021-22. Then we see we have some prioritization. We do not have specific figures for the vaccines, but then we see in the program budget, we see prioritization towards facilities with functional cold chain equipment. Yeah, so these are equipments for storing the vaccines, because we know that especially some of the vaccines, apart from actually even AstraZeneca, requires cold storage, and some vaccines such as Pfizer even requires much deeper cold conditions. So I think government is trying to prioritize that, and we see an overall increase, but we do not have specific figures out of that 121 billion, the specific figure for the vaccines. Then, or rather, we did not look for it. Maybe we need to check further across the functional based budgets. So the government releases two kinds of budgets. So we have program based budgets, and then we have line item. So line item specifically looks at the specific funding areas. So I think we can check whether we have that allocation. Yeah, so regarding the recurrent versus development budgeting, we see when we look at the overall budget in terms of the allocation, the fiscal responsibility threshold, which is 30%, at least 30% to development, that principle has been met on overall budget. But then we have specific, of course, that principle does not apply across the board, because we have some sectors, for example, education and national security, and even governance, justice, law and order, which are mainly service-oriented sectors. So on overall, that principle has been met, but it does not apply to some of these sectors, which is which is expected. But then, while in terms of the allocation, budget allocation, most of the MDS have been meeting that threshold. The issue has been on the actual budget implementation, the expenditure. So that is issue that we need to track to see that that threshold is met, especially to the applicable ministries and departments. Yeah. That is it from me, John. Thanks.
Thanks, Noah. Darmi?
Thank you, John. Noah has explained well the question on recurrent and development, but just to emphasize on the question from Martin on vaccination, we see that the increase in allocation to the health sector is only 2 billion, but looking at the requirement that is required to achieve the herd immunity of 70%, that doesn't seem sufficient. So I think it's the slight increase in allocation to the health sector does not show the priority of achieving the 70% immunity. Thank you, John.
Yeah, thanks, Darmi. Raphael?
Yeah, I think, John, I have a couple of questions that have been posed. One is by Emma with regard to the exemption of VAT on exports. And one of the things that I mentioned is that our proposal was that we are proposing that we delete this proposal, because the bill is proposing to remove VAT exemption on services sought by other firms which are outside Kenya, and that adding VAT, of course, what it means is that it is going to increase the cost of those firms in Kenya, making them a little bit uncompetitive. And the other question that has been addressed to me, and I think I answered partially, is on registration and regulation of corporate trustee. But the angle was the impact that it would have on SMEs. And what I said, what I mentioned was my view was on mentioned something to do with better asset protection, and of course having a higher investment in return. However, one of the things that I would mention is that when you're talking about corporate trustee, which according to the bill will now be registered and regulated under the Retirement Benefit Act, the bill introduces the issue of corporate trust to refer to a limited liability company, and of course it will be incorporated in Kenya. And what it means is that the instrument or the definition of these powers mainly would be to undertake the trustee and include those trustees in the corporation. The other aspect, the question that was asked by Murwa, was it Murwa, is on the room for progressive tax, and the issue whether we can have that room. I think we can have that room, because when you're talking about progressive tax, you are talking about pressing tax burden on the rich rather than the poor, and basically it would mean that we'll have to structure the tax. We need to restructure the taxation issue so that we are able to capture the wealthy and be able to collect as much revenue as possible. And the other aspect is to ensure that we have tax reliefs and tax rebates for perhaps the poor and perhaps people who are willing to disclose their taxes to the government. The question of tax base and tax rate actually plays a critical role in ensuring that the way the government lays out how to tax its own people, and therefore the burden on who should be paid, who should not paid, who should pay more to the taxation bracket, actually is on how the government actually base its taxes and tax rates. So thank you, John.
Yeah, thanks, Raphael, Noah, and Darmi for your responses to some of the questions that have been posed by our participants. And again, of course, thank you to our participants for those questions. In case one or two questions are not clearly answered, we'll post the responses actually on our website. I mean, just maybe to add, I know I saw there was a question from Molo on the extent to which the budget is gender responsive. So we haven't, in analysis of this budget, we did not factor in the extent to which it is responsive to gender. Maybe that's something that we'll consider doing in future. Of course, we have some other projects that will be doing some work outside this, that it's touching on aspects of gender responsive budgeting with a focus on women economic empowerment. So maybe that we'll share. I mean, we'll be able to share some insights around this when you complete that study. So that's something that I wanted to note. Of course, what Njagi mentioned is, yeah, we'll consider doing further analysis on just the tax and on the issues of the effect of some of the tax proposals. I think those are the two things I wanted to add. Yeah, so those are the two things I wanted to add. And then just the other general comment before we bring this to a close, and as a way of, in terms of my closing remarks, and actually maybe before I do that, I forgot to ask Raphael, Darmi, and Noah, maybe you could make your final remarks before I conclude and bring this to a close.
Yeah, thanks, John. My concluding remarks is that the budget being proposed is huge, and the deficit, I mean, it has caused the deficit to increase significantly from the previous period. And given the situation in which we are, the COVID-19 pandemic, the issue of revenue mobilization is likely to remain a challenge, and that is likely to impact negatively on the budget implementation. So there is need for improved revenue forecasting to ensure that at least we're within our means as a country to avoid increased budget borrowing. Yeah, thanks, John.
Ms. Darmi?
Thank you to everyone who spared their time to join in today. My remarks will be that there are various declarations that Kenya has signed and is party to. For example, the Maputo Declaration for Agriculture and also the Abuja Declaration for the health sector. But we see that the 10% allocation for 15% allocation to health sector is not yet met. Also the 10% to agriculture sector as stated in the Maputo Declaration. So it's important that we match up our budget allocations to our policy priorities so that they're not just stated policies, but the budget allocation reflects our commitment to achieving those policies. Thank you, John.
Thanks, Darmi. Raphael?
Yeah, thank you, John, and I want to thank everybody who participated in this forum. But one of the things I want to mention is that if you look at the finance bill very clearly, what it tells you is that the government is focused more on trying to enhance some of the tax policy measures that were contained in the Finance Act 2020. But more so, looking at some of the proposals, for example, on the medical products, given that we are in the pandemic, I think it would have been a welcome move for the government to give it a better approach. For example, instead of exempting those items, medical supplies, I think they should have been zero rated, so that it's clear that suppliers can be able to qualify for deduction of input tax. So that one would have been more key. So thank you, John.
Thanks again to our three speakers for taking us through the highlights and sharing insights on what we expect from the National Budget 2021-2022 and what it means to us as a public and to the different sectors of the economy, to households, to farms, and to the public sector. So of course the details of this will be, we have more details in the report. So hopefully by Monday next week, we will, by end of day Monday, we will post the analysis. And this is again to thank the entire IEA program staff. This is something that we did across programs. And so we've analyzed, we have more details. So this was just basically sharing some highlights, and those will be contained in the report. So please, I think towards the end of Monday, you can look out for that. We'll post it on our website. The recording for this, as well as the presentation, again, this will be posted immediately after this. So feel free to access this from our website. And I just want to also highlight the fact that on Monday, we will have another webinar from 11:30 to share our analysis, budget analysis that will focus, or that is focused on judiciary, parliament, and independent commissions. So as you can tell from this, we didn't touch on this. So on Monday, we'll share highlights of this that focuses on the judiciary, on the other two arms of government, as well as independent commission. So please look out for that. I think the banners have already been shared on our social media platforms. Otherwise, thanks a lot for taking time to engage with us on this forum. We are very grateful for the many questions and ideas, actually, even for further studies that we may consider as IEA. And we also take note of the various questions that some of the questions that have been asked, and we'll try and see whether there are a few things that we can tinker in terms of adding to the report in response to some of these questions. Otherwise, thanks a lot, and have a good afternoon.
Yeah. Thank you. Bye.
Bye-bye.